Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to this week's episode of the Prime Property Finance Podcast. My name is Mark, and in today's episode we've got our guest who is Chris Hill. Chris Hill is the head of sales for Accord Mortgages. Welcome, Chris.
Thank you for giving me the opportunity to come on to the podcast.
No, you're very welcome. And thanks for giving up your time. I know it's precious. So, do you want to give us a quick introduction as to yourself, who you are and your career to date?
I certainly can. So I've worked for Yorkshire Building Society Group, in which Accord is very much integral to for over 25 years. You could say boy and man, but built up experience along the way. I've worked in many operations roles as well as sales roles, and the last 8 years in Accord, with the last 2 being as the head of sales. But I've got a real passion for our industry. I think it's an amazing industry that we work in, and in property in particular. I've been a landlord in the past, and I've got now responsibility for all of the sales teams across Accord, which involves around 29 business development managers nationwide. We've got a team of business development advisors within our Bradford office, and we've also have what we call the retail broker program, where some of our colleagues in our retail business support some of our medium to small brokerages as well, giving extra support there. So that pretty much covers the team and the responsibilities.
Okay, fantastic. Thanks for that. So I think it's fair to say, the topic of conversation that we're going to take today, I think it's fair to say that you've got a very broad macro view of what's going on in the world of landlords and borrowing. So that's really, really useful. We've covered a lot in this episode around things such as products and what have you. We don't really spend that much time talking around what the market is currently doing and what that lender view looks like. So I think this is going to be a great opportunity to have that conversation. So yes, looking at the events that have unfolded, we've obviously got the new peace deal that has landed. So that's going to date this podcast somewhat in the future. But what are we actually seeing in terms of what the market actually looks like at the moment?
Well, in terms of the market, first of all, the good news is a deal of any type is welcomed right across the industry, right across the globe, I think, at the moment. And, the UK mortgage market is no dissimilar to that. We're really pleased to hear that. And from a market perspective and an economic side of things, we're already seeing quite a significant impact in the markets. Even this morning, the swap rates have reduced by about 10 basis points. We're looking at 2-year swaps at around 4.06, 5-year around 4.10. So that trajectory is really positive, and hopefully that continues. You can see Brent crude oil at $83 a barrel. That's $40 less than what it was at its peak, but it's still $13 higher than what it was pre-crisis. So there's still some move to go, and you can also already see in the wholesale markets around the cost of gas and what have you is already dropped by about 6% this morning. So all that's going to play through, we hope, to inflation, and maybe start to see some positive movements there. And that's one of the reasons that have been driving the concerns across markets in general. So what we're looking for, those lovely words of stability and confidence. And we know working towards Friday this week, where there's hopefully a signing of the agreement and the detail to be thrashed out and completed, Strait of Hormuz opened for natural flows, we can start to see some confidence really coming back into the market and really impacting demand and pricing, which I think is going to be really important. But, that's what we're we're seeing it's a moving feast, but some positive signs this morning for sure.
Yeah, and I think we've covered on the podcast historically how things like this impact swap markets. So our listeners are probably well versed in the swap market and how that influences interest rates. Now, obviously, them going down in the downward trend is great, and hopefully we get this period of stability that we all want. That being said, I think I've been using the word stability for the last 4 years, and I don't think it's ever come to fruition, but we shall wait and see. These things are sent to try us. I guess what I'm curious about is, with the volatility in the market as we've seen, how do you as a lender cope then with pricing? Because we went through a period when this first happened where products were coming out, then they were being pulled, then they were coming out, being pulled. To be fair, that has been less the story over the last 3 to 4 weeks. Swap markets have still been bouncing around a little bit, but not quite as volatile. How do you as lenders cope in those sorts of scenarios, and how do you try to minimize the impact, obviously, on brokers/borrowers?
Yeah, and I think it's a great question, and it might not feel like this from a broker's perspective all the time, but we are very conscious of jumping in and out of the market to which creates the impact on brokers and customers for that matter. But how do we find it? Well, it's very, very competitive out there. The market does feel as though it's contracted and people have been waiting a little bit more. We know that there was a real push initially for decisive action to be taken about 3 months ago, but there's definitely been a quietening of demand, certainly in the purchase market from what we're seeing. Remortgages and life events will always continue. But if you've got a bit of a choice, you might want to be a bit more flexible. But what we believe, if you take about it from a pricing point of view, I think that these next 6 months, there's been that demand that's been built from people maybe just waiting a little bit to make some decisions. And then with this hopeful feel of confidence, we may well see that demand starting to come back into the market. And I think that's going to be a really exciting opportunity, I think, for many of your listeners. And how lenders will react to that, we're looking to take opportunities where there are ones. So if that comes back into the market, we'll be looking to price as aggressively as we can, hopefully in a downward trajectory. That will create more opportunity. And I think for landlords in particular, over the next 6 months could be really positive as prices start to improve, stress testing softens, and hopefully that creates more choice. And I think that's what we'll see coming in the next 6 months if this stability and trajectory continues.
Yeah, and that's really interesting, because a lot of our clients, a lot of the conversations that we're having at the moment are obviously, they always are rate focused. However, I guess part of the conversation here as well is there's a supply side to that conversation. So are the opportunities actually out in the marketplace? So are people, and we'll come on to this in a second, around landlord behaviours in the advent of the Renters Reform Bill and so on. But I guess part of this conversation is around, is it wise to wait for rates, or is it wise just to kind of get on with it in the environment that we're in? And that's like this ever-evolving question that we never truly have an answer for. And I guess it's all opinion-based. So what would you say? What was your opinion on that side of the conversation?
It's a great question, and one that tends to come up when you're coming out of a cycle that we're hopefully coming out of at the moment. Some of the things that we would point to. So first of all, we've seen house price inflation reduce dramatically this year. We've seen properties in the south of the country go down in some locations, but in the more central and northern locations, we've seen stability. Dependent where you are, I think the opportunity is if you can get the property at below market value. Our landlords desire pretty much on all occasions. But I do think there'll be some opportunities there, because there isn't the demand. There's not as many people that are in the market for purchasing a property. So I do think that there are opportunities there. But having said that, it is a balance, and this is why the question is really difficult to answer, because there is likely to be some improvements from pricing, stress testing positions. I think that you will be a lot of desire from lenders to be getting their share of the market in an improving market position and a level of stability. So I do think we'll see some benefits from pricing, but I also believe we're going to see some opportunities for landlords to maybe acquire a property at less than market value. And then that's where the equation is, doing the numbers, doing the maths and trying to work out, 0.5% reduction as an example, or 0.25% reduction on price over a 2 or 5 year period versus a reduced cost of acquiring the property is where, but I do think there are opportunities on both sides, which I think is good news.
Yeah, and I guess, and again, this is horses for courses, right? So you've got your investor who is less driven by the day-to-day income and is probably looking at it for a future pension supplementary conversation or retirement planning. Then you've got those that really do require the cash flow because it's supplementing their day-to-day living. And I guess the impact of that conversation changes massively when you look at the value of the asset in the first instance. So what we're seeing is at the lower end of the market, you're sort of 80 to 120,000. They're still producing rental incomes of 650, 700, 800 pounds a month, depending on where you are in the country. Yet the loan sizes are proportionately small, so they're good yielding properties. Therefore, that conversation of I'm going to save 0.5% is probably less important than if you go through the average property value at 260, 270, and your mortgage is going to be a couple of 100,000. Then clearly that conversation is different. So I do think it's relative to the position of the borrower in the first instance.
Absolutely, I think that's spot on, and it depends on what the needs are of that investor at any given time and any given price point. As you say, the higher the value of the property, the higher the mortgage, the more impact they're going to have with 0.25%, 0.5%, and so on. But I think what we're saying is there are going to be opportunities. There may be opportunities in the property itself and getting it below market value, and then some benefits from a reducing potentially interest rate position as well. And I think that all needs to be factored in when you ultimately making the decision on when your next purchase will be, or your next remortgage might be, or whatever, or even potentially capital raising to invest in the property for whatever reason.
Okay, no, that's interesting. And then in terms of, we talk about economic indicators. Now, obviously, we've had the conflict in the Middle East, which has been dominating markets over the last 3 months. But setting that particular incident aside, what other indicators do you see in the marketplace that are most influential over swap rates and ultimately pricing?
I think ultimately it's inflation is the key factor, and but the conflict has obviously impacted that in terms of gas and oil and so on. Other factors that you're looking at is the amount people are earning each year, and that can be inflationary dependent on whether they're getting above average pay rises, for example. And you've also, when you look at inflation in the round, that's the bit that the Bank of England clearly focused on. We were in a really good position, weren't we? Just at the start of the year, we had a reducing interest rate environment. Inflation was certainly we'd got a grip of it, and things were going in a positive trajectory. We're going to find out over the next few weeks and months the overall impact on this conflict and how quickly we can reverse the inflationary position and how sticky that is. But all the other underlying areas, unemployment isn't getting out of hand. Yes, it's edging up, but it's a factor. But I think there is no doubt the political arena that we're in as well will have a factor on the overall economic position. We've seen that. We might have a leadership challenge in the next few weeks following the by-election, for example, and what Burnham's position might be versus what Starmer's is. I think what we've got with a Starmer-Reid's premiership is we do have a level of stability economically. Not everybody agrees with it, clearly, because there's the sense of a challenge on business and growth and thriving in that side. So I think it is going to be an interesting few weeks and months and what happens there. But in general, those I think are the factors that are going to impact on pricing and demand in the market over the next 6 months.
Yeah. Okay. No, and I agree with all of the above. I think so. What a question that I have then around inflation, and this is more a question around your opinion more than anything else, is how do you see? Obviously, the Bank of England only really have the base rate to influence inflation or to try and control inflation, and as we can already see, a large proportion of the inflation is driven by elements outside of what the base rate can control, i.e. spending. It's driven by obviously energy prices and so on. How do you what's your opinion on the base rate as an actual instrument to try and control inflation?
Well, I think it's the only instrument we have that the Bank of England can use to manage how we react to global and macroeconomic indicators levels. And I think that it's always reacting to, isn't it? So whatever's happening in the market, so house price inflation, it could be the price of utilities, gas, travel, aviation, all of those things. If those costs are going up, we know inflation is going to go up. If we see big pay rises going in the marketplace, that's going to have it's inflationary, and it is. I think it's the best instrument we have available to be able to try and increase demand or decrease demand. And that's the area I believe I can see it being around for a very long time.
Yeah, no, it's interesting. It's always been a debate, and I always wonder if it's not consumer spending that's driving the behavior. That's, interest rates control behaviors, and ultimately, if it's not consumer behavior that's driving inflation, then for me, it becomes almost redundant, but I'm not an economist, and I'm probably massively oversimplifying it, to be fair.
No, but if you take that example of consumer spending, consumer spending is the output of greater levels of demand. If that consumer spending is high, if it's low, obviously, people aren't using their money to buy goods and services, and therefore might need some stimulus of rates coming down to make the cost of most things cheaper to try and drive up that consumer demand. And I think that's where we're finding ourselves in. And I think in the mortgage world that we're in at the moment and what's happened over the last 3 months, sadly, that will have an impact on demand, both at a consumer level and at an investor level. So hopefully we can see a more positive trajectory in the next 6 months, and we can see demand return into the market, which helps, certainly helps lenders and helps brokers.
Yeah, indeed. And we semi-touched upon this in terms of what the next 12 months possibly looks like. Obviously, we've spoken about the peace deal, we've spoken about potential leadership challenge, and so on. We use the word stability. Obviously, if there's going to be a potential leadership change, then invariably that will not be a particularly stable environment to be in, because we just don't know. I think the consensus is that Starmer is going to be challenged. It's going to be challenged pretty hard, and I think Starmer is quite unpopular for various reasons, whether you like him or not. So I think, what do you think over the next 12 months? What are the likely things that we're due to see in markets, do you think?
I think one of the most important things is an improving picture, as we've touched on. I think that, as you've rightly said, any change to the leadership of the Labour Party isn't necessarily going to be well received from the markets, especially in the direction we're going into a more left position that might increase spending. Markets are comfortable at the level we're at the moment, I would describe. I think greater levels of spending will create a bigger reaction from the market. So, we've got to be careful what we wish for. And I think that's why we're seeing the markets being comforted by Starmer remaining. But there's a high likelihood that will shift. And I think if that does shift, it's how well a potential Burnham, we're speculating here, there'll be other people, no doubt, within the contest. But whoever potentially comes in, if they come in, and they are likely to increase spending to improve some of the things that the current government aren't able to, then it's how well that's balanced. And I think that story and the credibility of what they're going to do, how they're going to do it, and ultimately how they're going to pay for it is what's going to be critical for the market and the economy.
So we've spoken about swaps at length, and obviously they are prediction engines, or they're predictions of what things are going to look like in the future. And I guess, we keep joking about stability, but stability means that you can forecast quite accurately if you know what the path looks like. And we talked about, or we've spoken about historically around why the 2-year swaps or the 2-year rates have been more expensive than 5 years, whereas normally they're the other way around. So I think, what this speaks to is any sort of potential change creates uncertainty, uncertainty creates instability, and therefore we will see that reflect itself in some way, shape or form going forward. So I guess the main thing is, if you're already in your debt, if you're a landlord in a debt cycle with a 5-year fixed, you needn't worry about any of this stuff. This is only pertinent if, you are coming to an end of your fixed rate, or indeed if you are looking to acquire and you need new borrowing.
Absolutely. And you can see the difference between the 2 and the 5 being so close now. I think, 0.4 basis points. So it's so close that what, the market is suggesting is that whether you be thinking about 2 or 5 years, the rates are going to be pretty stable through that period. So waiting for something to happen doesn't, from a market's perspective, doesn't appear to be something to worry about too much, because the markets are suggesting it's going to be quite stable between the next 3 and 5 years.
Yeah, no, I agree. And it's a good distinction that in that part, in the 5-year forecast is stable, 2-year, bit of uncertainty, and that's why it's been reflected as such in the rate. So it's a good thing on that. So moving on ever so slightly from the economy then, and there will always be an undertone of the economy and conditions, is what, in the view of a lender, makes a good landlord as a good landlord borrower? So what are you looking for in terms of good characteristics from landlords?
Yeah, I think, if you take Accord's view on this, I mean, we do a lot in the first-time landlord space, but equally our position improves when there is some experience in there. So experience of showing that you can manage and pay your mortgage effectively over a period of time. So that experienced landlord title, somebody who's done it for at least over 12 months is sort of where we work to, and does that well and does that effectively is something what we're looking for. We're looking for landlords that can show that they really understand the market, what they're trying to achieve, and they've got a clear plan. And that plan's building. You might be part of building a portfolio over a period of time, but they've got clarity on what their goals and aspirations and what they're trying to achieve. I think from our point of view, we like to see a landlord where we've got balance. So they might have a higher or less equity in 2 or 3 of the properties, but lower equity in the other. It's something many lenders will look at, and it's the overall balance that matters. And for us, we work with what I would say the landlord community up to around 15 properties. So we're not the bigger portfolios. So when I'm describing this, I'm not describing it on all lenders clearly. I'm giving you a flavour for what we look for. At Accord, we're looking for those medium to the larger portfolios, but our sweet spot isn't the large ones. It's up to 10 or 15 properties is the sort of arena we operate in.
Okay, and fully understood. And I think, to be fair, once you go beyond 15, the dynamic shifts anyway. It's a different environment.
Absolutely.
And a fundamentally different conversation in that respect. And what's interesting as well, I think, in terms of what makes a good landlord. We talk a lot about pricing and rates because we deal with mortgages. However, that may not be the biggest issue that a landlord would face. So void periods, maintenance costs, disputes, all of these sorts of things can completely erode any profit over and above the cost of a mortgage. So I just think that perhaps because we end up having this conversation every day, sometimes we put a lot of weight onto rates, and whilst they are important, of course they are, there's debt associated to it. I think there's a much broader conversation, and that speaks to the experience part. So those that can navigate voids sensibly, if you've got a slightly larger portfolio, 4 to 6, then one void is going to be less impactful on the portfolio. And then also, I think as well, those that see this as more of a business as opposed to an investment are probably the stronger landlords, because there's a slightly more professional air to them, and they seem to have their ducks and systems and processes in place to help manage these challenges that are ultimately going to turn up.
Absolutely. I echo what you said there. I think that those are the attributes you would look for in a professional landlord. And I think that, how they conduct their affairs, when you start to look into reviewing their credit status or how they operate, you can see a lot from whether somebody's got their ducks in a row, they're organised, they're planned, they're on top of things, there's no late payments, missing activity, both in as you review the behind the scenes underwriting of any given opportunity. So it gives us comfort when you can see that that's been handled really well, professionally organised, and that gives our underwriters the comfort to be able to want to say yes.
Yeah, and I can speak to that, as I say, because we have this conversation multiple times a day. Is mortgages is more than just does the rent cover the mortgage payments? That's entry level criteria. Does it stack? There's a whole host of decisions that go on in the background. Some lenders are more relaxed than others and have different appetite and so on. But you'll ultimately find that in its pricing and that sort of thing. So I think getting your feedback in terms of these are the sorts of component parts that make a lender decision a good one is interesting. Do you see any common mistakes that that landlords make when applying for mortgages?
I think some of the things that I would describe is the picture and the story is really important of what the position might be or why a scenario might be as it is. I think the explanation is key. We're a very common sense lender. We do 1 in 3 of our mortgages are outside our criteria set, and that is whether it's be a residential mortgage or a buy-to-let mortgage, we have that level of flexibility. And what we say to our broker partners is, if there's some information or there's something in the background, explain it, explain why it's happened, and we will do. We would much rather that be the case. Oh, look, this doesn't make sense. Why has that happened? We'd much rather have the full picture so we can have a holistic review. So one of the hints and tips, certainly towards the broker community, as much as landlords would be, but if your landlords are speaking to your brokers, is just let's have the full picture from the start. We've got a much better opportunity then to be able to have a positive outcome to the lending decision.
Yeah, and I think that comes from multiple places as well. So if it's a no, we want a quick no. We don't want to spend 3 weeks touching it back and forth and ultimately end up with no. We need to know that as quickly as possible, because that instantly puts you on the back foot, as though you were trying not to disclose something or trying to get something through, as it were, from that perspective. So yeah, I couldn't agree more. Being transparent and just framing or presenting the challenge in the right manner usually gets the result that you need. Even if it's not a yes, as I say, we just want to get quickly to that no if we can. Okay, so looking at that then, I've got a few more questions then. We've got a bit of dare I say, a quick fire, but we'll see what they are. Nothing's quick fire with this sort of stuff. In terms of, again, what we're seeing in the market, Are we seeing, we've had the Renters Reform Bill, now that's going to take a little time to manifest itself into the marketplace. It only landed a couple of months back. And I suspect, we're looking 12, 18 months into the future before it has the desired outcome. People get used to it. But are we typically seeing landlords becoming more professional in nature with before and post this?
I think we are. I think that knowledge and understanding of what the changes could mean, and how you would react to it, I think drives towards a more professional landlord that knows what they're doing and what they want to achieve, and whether these new reforms can enable them to do that. The second bit that I would just highlight is the minimum energy efficiency standards, the MEES, that are due to come in 2030. I think one of the biggest pieces of advice I would give to landlords who might have a portfolio at the moment, that they might be looking at that 2030 number and thinking, that's miles away for me. Then I think I would ask them to think again and to consider how they're planning for achieving those requirements as we build up to that 2030 date. So, you might be coming 2 years before, let's say 2028, you might have one of or some of your properties coming up for review. Is that a time to look at the opportunities, think about whether you want to potentially borrow some additional money to be able to get ahead and be ready to be compliant with those requirements come 2030. I mean, I sit on the Green Mortgage Advice Initiative and the steering group there, and there's so many things to consider in that space. Energy Savings Trust have got a brilliant calculator that can help you understand where you are today, where you might want to be in the future, and what it'll take to get there, and how much it might cost, and what are the right options available. There's more information coming, and EST are a non-for-profit making organisation, so one that I think might be beneficial for some people. So it's just starting to think about those things, getting ahead of it, not leaving it to 2030, because who knows, if there's a huge demand at that time for contractors for certain products, that might drive the price up and the availability up. So it's all in the round, and definitely something I'd be considering finding out more about if I had a portfolio today.
Yeah, no, and I think that's good advice. And I know, again, having speaking to landlords on a regular basis, is that I guess there is a challenge here around, or there is a feeling that this can keeps getting kicked down the road. And therefore, do you want to run and make all these changes now because you don't know what you're changing toward? That's one risk. You could get yourself to EPC C now, for example. There's talk of the EPC ratings changing. There's talk of the whole process changing. So I understand there's a conundrum at the moment. So even if you don't do or take action, I guess the actual advice would be at least have a plan in place, map it out, understand based on what you know as of today, what would that look like? What is the cost implication, and how do you fund that? You may not need to start, how far out do you need to start that process? If you've got 50 properties, you need to start a lot sooner than somebody who's got 5, for example. So have that plan in place to understand actually, 4 years we're talking about now. 4 years isn't a long time if you plan on doing one a year and you've got 10 properties. It's just not going to get you there.
Absolutely. And I think, there's in life, never mind in managing a portfolio, you at times where there may be change and things are changing around you, you've got to focus on the things you can control. And, we do know that the minimum energy efficiency standards is committed to. It's 2030. There is some talk around EPCs and some flex there, but we don't know that today. But understanding what we know today, what your property might need to get you to where it needs to be, what the cost might be, and starting to understand that and plan that out, especially as you come into potential cycles in your review of one of your properties or several properties. is definitely something that I would encourage people to start to take action on, to work towards a plan, if nothing else.
So what would you say is the one thing that landlords believe that lenders simply do not agree with?
What do I think that landlords believe? Well, I think the first thing I would say is that lenders, or certainly the lender I work for, Accord, really believe the importance of landlords in the UK housing market, and we absolutely want to encourage them, and we want to provide the conditions for them to be able to run their business and do that effectively with credible lending solutions. So we absolutely believe in the market. We want to encourage it, and we know the importance of landlords in the UK housing market, and we believe they're a big part of its future. Whether landlords absolutely believe that sometimes, I'm not so sure, but I can, speaking on behalf of Accord Mortgages, yes, we absolutely believe that, and we want to support the landlord community both now and into the future without a shadow of a doubt.
Yeah. No, great answer. I think if I was being a bit more bullish on my answer, I would probably say that the perception, what landlords believe of lenders is that they're making all this money. What they're forgetting is the operational costs and the cost of funds, and just understanding how tight that margin is between delivery and actually not the amount of capital that's got to be put at risk in order to make a return is extortionate.
Well, this is it, and with most banks and building societies, there's a real diversity of opportunity that banks and building societies use to create value for the business, and it is exceptionally competitive at the moment. Really, really competitive. I don't want to go back into swap rates too much, but you look at the numbers. You look at what the swap rates are that we've just quoted earlier, and then the price of mortgages for landlords right now, and you can see in that there is not much fat there, and we've got to be really efficient with everything that we do. So I can be really strong on that one.
Yeah, no, fair enough. That's fair enough. No, I couldn't agree more. Okay, so a couple more then is, what worries lenders most about the market right now?
We've got to be careful with the word worry, I think, because whatever the situation, it's how adaptable and how you respond that really matters. I think that we would love a market that is more stable. The outlook looks really good. We've got an interest rate environment that might be going in a trajectory that makes home ownership or buying your first investment property in reach for more people.
No, fantastic answer. And then in terms of the opposite then, so what's currently giving you confidence in the marketplace right now?
Well, on the flip side of it, I think there's been a real period of stagnation, or certainly a low number of transactions, and the demand has been suppressed. I'm really excited about what these next 6 months could look like. Stability, confidence returning, rates potentially nudging down, stress testing loosening, risk profiles improving as the market improves, and getting a market that's really firing and buoyant. I think that will be exciting, a great opportunity, more choice for landlords, and hopefully that means even more competition, so better pricing overall for customers as well.
Yeah, no, and outside of that as well, what we do see, in all credit to mortgage lenders, is pricing. It's a zero-sum game. You can only get down to zero. So there's only so much you can do and influence on as far as pricing is concerned. So what we are starting to see in the marketplace is where lenders are trying to help in other matters. So where they otherwise wouldn't have gotten involved in transactions or deals or structures or whatever it may be, price is now becoming, clearly it's a part of the conversation and still a large part of the conversation, but it isn't the only part of the conversation. So that's what we tend to see in the marketplace right now as well on that front. And then just, I think to finish us off, I quite like this question. So what are the best landlords doing differently?
Gosh, that is a cracking question. You know, we've touched on the organisation planning. I think the best landlords that I interact with, they're really well connected. They understand the market. They've got a really good handle on some of the key levers that might impact their portfolio or the decisions. You know, whether it be highest price inflation, whether it be market dynamics. They've got a sense, they're well connected, they're educated, they really understand the regulatory environment well. They understand the impact of sustainability and the important role that they play in there. But equally the ones I think that really care as well. And what I mean by that is, yeah, it's a business, but they do care about the customers that they've served, the people that are living in their properties. They're trying to create, you know, really good rental properties for people to build their lives and to thrive as well. And I think if you've got happy tenants and a happy landlord, that's a fantastic equation. And I think there's a lot in what I've just said there, and it's not easy to keep abreast of everything, but hopefully podcasts like this to educate and inform, you know, it would be the landlords that switch on to things like this and to be well connected in the market that I think will thrive in the future.
Yeah, no, and absolutely. I think what it gives them is an informed decision on today, but also an informed outlook on tomorrow going forward. So, and rather than being reactive in the marketplace, you know, being proactive. We spoke about, you know, energy and sustainability and that sort of thing as well. So, as I say, it's not just then focusing on interest rate. There's a whole plethora of things they need to factor in to make a portfolio sustainable. Otherwise, just sell it.
Absolutely sustainable and desirable in the future, you know, and a property is efficient, working well, builds that are sustainable for the clients as well, to me will create not just a more desirable property for now, but a more profitable property exit in the future. And that's an opportunity, if done well, could really differentiate a landlord both for now and the future.
No, fantastic. Well, thank you very much. I think I really enjoyed that chat. I love all things economy and what have you. So, I really enjoyed that conversation. So thank you very much for your time this afternoon. And hopefully our listeners won't know this, but we've had so many technical issues. It's been unreal. So thank you for your patience on that front as well.
You're very welcome, and thanks for the opportunity to come in on and talking to you all things market economy and landlords and buy-to-let.
Yeah, well, fantastic. Well, thanks very much, Chris. Appreciate your time, and I look forward to speaking with you soon.
Thank you.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.